We are live. Hello, everybody. Welcome, welcome, welcome to the censorship capital of the world, the United States of America.
North
And
Korea might object to that.
who might object?
North Korea.
Yeah, well, okay, fair
Or
enough.
actually, they won't object because they don't know.
Yeah, you're right. They don't know. See, that's the whole point of why censorship is so dangerous, because you can't hear the dogs that don't bark. You can't evaluate or think of anything that you never read or hear about or see, right? It's just not there. It doesn't exist. And that is the cancel culture for you. So congratulations to the oligarchs who are censoring our thoughts and our speech. It's like the modern version of the TASS news agency that controlled the thoughts and speech of the Russian population, or not the Russian population, the Soviet Union population back in the day for many, many decades. It was founded in 1904, but when the czars were taken down and the Soviet Union was really, in its prime, man, it was all about the TASS news agency. That was the only place you got your news, and it was the only place that you learned about anything in terms of current events or politics or whatever. But hopefully we will not go there. Hey, so today we are going to talk about something you've been hearing a lot about in the news lately, and it was also another example of censorship, and that is Robinhood. And yes, there's Robinhood the character, and there's Robinhood the app. So we'll be talking about both of those things today, because Adam has prepared a couple of good thoughts and visuals for us to look at there. But if you've been following our work for any length of time, you know that about, 16 years ago now, I originally published my 10 commandments of successful investing. And I would say the one of those commandments that has resonated with the most people is commandment number 3, trace. And commandment number 3 is, thou shalt maintain control. See, we recommend that people be direct investors, so they control what they invest in. They aren't relinquishing their financial future and their financial well-being and their money to somebody else. They're a direct investor, so they decide what to buy, where to buy, when to buy, how to finance it, who to rent it to, how much to rent it for, which property manager to hire, or if they want to self-manage their property. And we teach people a lot about self-management. So many, many great things are available when you maintain control, when you follow commandment number 3. Now, on the flip side of that, what happens when you don't follow commandment number 3? The 3 things you leave yourself susceptible to, and there are more than 3, but the 3 main problems are, number 1, you might be investing with a crook. And we've all heard about all of the Wall Street scandals. They are ongoing. We're talking about another one of them today, actually. So we'll get into that. But you might be investing with a crook. It might be Bernie Madoff. It might be WorldCom. It might be Enron. It might be MF Global. It might be whatever. It might be just trading on the Robinhood app. They haven't been convicted of a crime yet here, but many people think what they did is criminal, and their involvement with the hedge funds. And we're going to talk about Citadel, of course, today. So we'll dive into a lot of that stuff. But suffice it, and this could be true in real estate, right? If you invest in a syndication, in a fund, you leave yourself susceptible to the morality and the ethics, the honesty and the integrity of that fund manager, that deal manager, that general partner, that syndication manager. So number 1 problem, you might be investing with a crook. Okay. Number 2 problem, you might be investing with an idiot. And you don't want to invest with an idiot, because you can lose your money either through their crookery or their stupidity. And neither one of those are good. So let's assume you pass the first 2 hurdles. You invest with someone or some company that is honest and competent. The 3rd problem is, assuming they're honest and competent, they take a huge management fee off the top for managing the deal. And years ago, I discovered a great book called War on the Middle Class. I highly recommend you get this book. I discovered this book about 16 years ago. And in chapter 2, the author, Lou Dobbs, who's been in the news lately as part of the cancel culture because he was just let go from Fox News because, hey, the elites don't like what some people say, right? And the voting machine company is now suing everybody for saying that there might be irregularities. That's what's happening, right? But Lou Dobbs in chapter 2 talked about how the CEOs, the boards of directors, the executives, the C-suite people in these publicly traded companies are making absolute ungodly fortunes. And it is so out of proportion to the rank and file workers in the companies, and how that ratio has changed so much over the years. It's just massively, massively changed. And, this is part of the inequality debate, the wealth inequality, income inequality debate. And it's all, very, very valid. But he also talks about directly the CEOs and what they've made. So I'll give you one example that I can just remember off the cuff. My numbers might be ever so slightly off, but they're close enough in an era when we talk about millions like it's nothing and billions like it's nothing, and soon trillions like it's nothing. We're basically talking about trillions like they're nothing now too, with all these crazy stimulus packages. But he gives the example of Larry Ellison, the founder and CEO of Oracle. You've all heard of Larry Ellison. He's kind of an eccentric millionaire, playboy, does all kinds of extreme sports, kind of like a Richard Branson type. And he's been at war with Bill Gates for many, many years. And they're doing all sorts of dirty tricks to each other over the years. Not as much now since, they're doing different things, especially good old Bill, who's suddenly become a healthcare expert. But I won't go down that rabbit hole too. But Larry Ellison, in 2 short years, from the year 2000 to 2002, Larry's personal take from Oracle was somewhere around $730 million in 2 years. That's almost $1 billion. Now that would be fine. What'd you say?
Not a bad wage.
Not bad.
You
for
live
two,
on that.
You could live on that and probably buy some nice wine and go on a few nice trips in private jets in 2 years. So that was his take from Oracle. Now that would be fine with me if all of the shareholders in Oracle made a lot of money on their investment. And if all of the other stakeholders in the company, the employees, the vendors, were being enriched as well. But during that same 2-year period that Larry took nearly $1 billion out of the company, the shareholders, the people who had faith in his company, the people who bought his stock, lost 61% of their investment during that same time frame. And this is totally legal, okay? But it just shows what a massive disconnect there is between the interest of the investor and the interest of the person controlling the investment. And this is why you want to follow my commandment number 3 in my 10 commandments for successful investing. A lot more on this on the Creating Wealth podcast or on the jasonhartman.com website. So that you are a direct investor, you are in control, and you don't leave yourself susceptible to the 3 major problems. Again, number 1, you might be investing with a crook. Number 2, you might be investing with an idiot. And number 3, assuming they're honest and competent, they take a huge fee off the top for managing the deal. Adam, let's go to you. Do you want to put your slides on the screen or react to anything that I've been saying?
Oh, yeah. The stock market is, the whole thing, it's just so completely devoid from the real world that, I don't even know what to believe in anymore when it comes to.
Especially now, right? It's just so detached from the entire economy. It's, I like to call Wall Street the modern version of organized crime, right? And it is detached. Yeah, you're definitely right.
So I can't throw my slides up, but if you can throw them up there, I can run
put them up there. There we go. Well, are they? Hang on here, folks. Okay, now we've got them up there. So Adam, Adam is going to talk to us about Robinhood. Now, which Robinhood are you talking about, Adam?
So this is the new Robinhood, a reverse from the fairy tale, where the fairy tale we robbed from the rich and gave to the poor. But in today, you see all the Wall Street, you rob from the poor and give to the rich.
Absolutely.
And
that's the new motto. That's the new mantra.
And you know what? They're doing pretty well. And you know what? When the rich get caught stealing from the poor, they throw them a dime.
Yeah.
That's, and not only that, but they throw us a dime and it goes to the federal government. It doesn't go to the investors for the most part.
Yeah, and what it does ultimately, it just causes inflation. So the poor actually ultimately get poorer, but they're pacified in the moment, right? And so they don't get out their pitchforks and and cause too much damage, because they throw them a bone, right?
Yeah. So first off, to everybody, the reminder of welcome. If you have any questions, comments, or need any help, you can go to the website jasonhartman.com. If you're in the United States, give us a call at 1-800-HARTMAN, HARTMAN, and you can get a hold of us there. So to get started, and just I know probably everybody's heard of it now, but we're just going to do a quick rundown of what happened with Robinhood and with the app. So number one,
you've got a great review here, Adam. So thanks for bringing it, because I think we all need, we need to kind of back up and just look at the big picture. So this is an overview of what happened.
Yeah. So, people downloaded the Robinhood app, put their money in, and they make a trade with Robinhood. Robinhood doesn't actually run the trade. They sell the trades to Citadel, the big hedge fund. Citadel front runs your trade and profits off of that. So they know that trade's coming, so they're able to pocket a little bit off of the trade, and they're able to pocket off of the also off the fees that they get for processing the fund. So it's a great business model for them.
Now you use the word front running, and front running is actually, I believe, an illegal activity. And maybe you didn't mean it exactly like it was the technical illegal activity, but do you want to ferret out front running a little bit?
So you have to get caught doing it is the really hard thing. Mm-hmm. So they're able to move the market, and they know where the market's going to move. So it allows them to make trades. I mean, if you get a million trades into your account and you know what you're going to trade, maybe you just run your trade first, or run it a quarter of the way through and make sure that you end up on the winning side. So can I prove that they front run? No, but based on our history with Wall Street and the vast likelihood, they probably do. And even if they don't, they know what's happening, and they know, and they're making money off of it. So then it comes across the clearinghouse doesn't like the trades. A lot of people at first thought Robinhood, the company, shut it down. But in listening to the interview that their CEO Vlad did with Elon Musk, Jason, did you catch that?
I did not.
Okay. Yeah. So Elon Musk got on some app. I don't remember the name. It starts with a C, maybe like Classroom or.
Oh, no. He was on Clubhouse.
Clubhouse. Thank you.
I heard about that. A lot of people were talking about it.
And Elon just said, what happened? And he said that he was woken up at 3:30 Pacific time that Wednesday morning, and they had gotten a bill from the clearinghouse of how much they needed to have in their account to allow them to continue trading, because the clearinghouse decided that the trades were too volatile, that they didn't like where it was going. It was an order of magnitude better, so 10 times bigger than they usually get. They wanted $3 billion from them to allow their investors to continue trading. So they wanted $3 billion. Up until this point, Robinhood had only raised $2 billion as a company in its lifetime. So they're demanding $1 billion more than they've ever had in their wallet just to continue allowing investors to trade. So Robinhood says, hey, we don't have the money. We can't do that. Immediately, this is how transparent this is. Immediately, they cut it 54%. They said, okay, 1.4 billion, you're back in the game.
Well, and when you say transparent, you don't mean transparent in a positive way.
No.
You mean what you probably mean to say is how obvious or just obscene it is for them to, it's like with no apology, right?
Yeah. Vlad came out in the interview and said they don't actually show the formula for how they come up with these numbers. He said they can kind of backtrace it and figure it out. But I mean, this is just how subjective it is. They say 3 million. Robinhood says, I don't have the money. So they say, okay, 1.4 billion. where'd that 1.6 billion go? So it obviously wasn't as that volatile. So then what happens? Robinhood says, well, we don't have 1.4 either. What if we just mitigate the risk, or do what you think is going to mitigate the risk, and we won't let them buy the stock anymore. We'll only let them sell the stock, which, as if you think about it for any extended period of time, knows the stock can only go down when you do that. If everybody's rushing to sell, the stock's going down. And whenever you do that, we'll cut it down to $700 million. If you make these stocks drop in price, we will drop it 77%, and you can do it for $700 million. And Robinhood said, we actually have that amount of money. We'll do it. And GameStop dropped 44% in that day.
We need to start using some sound effects, Adam.
This is just the amazing thing to me here is, you think of Wall Street and all these traders and everybody going off of numbers and all of these things just being driven by a big algorithm, but this is so clearly, blatantly, just them throwing numbers into a well and saying, hey, you owe us this much money. I mean, you look at Wells Fargo, whenever they get fined, they'll say, oh, you owe $2 billion, and they'll negotiate it down to $1.5 billion or trillion or however much they owe that day. And it's just the cost of doing business.
I'm so glad you mentioned that, Adam, because I noticed that many years ago with these big title companies that we would deal with in when I was in traditional real estate. It's like all of these companies, it's part of their business plan to pay government fines. It's a protection racket like the mafia used to have, right? They'll let them have their monopoly. They'll let them abuse the consumers if they just pay some additional money every year. It's absolutely disgusting. Like my business, for example, has no budget and has never had a budget to pay government fines because we've never paid any, thankfully. So yeah, it's absolutely ridiculous.
And it's incredible that a clearinghouse can basically demand and say, I don't like the way that Jason Hartman is trading. I demand that you stop letting him buy that so that I will allow you to continue working as a business.
This is insane. I mean,
can you imagine if the NAR came up to you and said, Jason, you are not allowed to buy, your providers aren't allowed to buy any more properties in Florida. They can only sell the stock they have now.
Right. And Adam, NAR, just for people who don't know, that's the National Association of Realtors. Okay. Of which I have not been a member for a while, but I get the idea, or the Real Estate Commission, like a government agency could say that, right?
Yeah. To say, hey, you guys aren't allowed to buy in Florida anymore. You guys aren't allowed to buy in Alabama anymore. I mean, it wouldn't happen, but it's just incredible to think that they can just come in and say, all these millions of people who are doing that, well, we think they're too dumb. We think they're too dumb. They don't know what they're doing with their trade, so they're going to lose money. So we're going to make them lose money, I guess, by making the stock crash. So that's so then the shocking news, which everybody was so surprised to learn, and Wall Street Bets on Reddit did this because everybody was going short GameStop and they wanted to, stick it to the man. Who was the major holder of a short position in GameStop? But Citadel, the company who buys the trades from Robinhood. But
how convenient.
I'm sure it was just a coincidence.
Just a little coinkydink, folks. Yeah, unbelievable.
So I just wanted to run this by so people could see how when you don't have control, when people can limit what you buy, what you sell, you think about trading as this thing you can just do. Anybody can do it. You just make an account and you trade. Well, if you made an account on Robinhood, you couldn't trade, but guess who could trade? The big boys who weren't using Robinhood. They were trading Robinhood just fine. They could short it whenever they said, hey, you can't buy the long position anymore. And guess what? So the people you try to squeeze out with the short, they just short at a higher price. And guess what? They're doing just fine today. Maybe they lose a little bit of money, but
yeah. So let's just talk about what shorting is and why it matters and why it was so significant to these hedge funds and these billionaires. Do you want to go into that, Adam, or should I?
Sure. So basically, the way that a short works is you're betting on the price to go down. So you essentially sell a share that you don't have to someone for the price that it is now. So say, I think with, if we just make it easy, you say, hey, there's a stock, I'll sell it to you for $10. And the person says, okay, I'll sell it for $10 because they think it's going to go up, or they, have a good idea it's going to go up maybe. And so they'll say, yeah, $10 is a great deal. And so then I don't know exactly the length of time you have to cover it, because I've never gone short anything. Right. But essentially you wait for it to drop in price. So maybe it goes down to $7. Then you have to buy the share and give it to them. So if it goes down to $7, you just buy it at $7 and you give it to the guy and he gives you $10, you pocket $3. Well, in this case, a lot of these hedges had shorted GameStop at probably like $20 or $30.
Yeah. So basically they were trying to kill GameStop. Oh, yeah. And the Reddit people on the Wall Street Bets subreddit, they wanted to defend GameStop essentially, right? And and the shorts are done with leverage. So the multiplier is just devastating, but when they win them, it's just like a flood of money, so.
And shorts have an unlimited risk.
Yeah.
Because theoretically, GameStop doesn't have a top. It could go up to $1 trillion tomorrow. And then if that's the case and they have to cover their short, then they have to buy it for $1 trillion and sell it to a guy for $10. So you got a massive thing. And I haven't seen it anywhere, but I heard that one company was short GameStop 140% of the stock value. Because they were so leveraged.
Wow.
That it was over 100%. I haven't seen that anywhere, but I heard somebody talking about it. So, but I mean, even just the idea of being anywhere near that amount that you can be close to the value of the company short is incredible.
Yeah.
And I will fully admit, based on all of the ratios that Wall Street has, when GameStop ran up to $400 or $500, it probably wasn't worth it, in quotes. But in reality, as we've been told, throughout time, something's worth what somebody's willing to pay for it. So at that exact moment, it kind of was worth $500. So they're basically just saying, we don't think people are smart enough to do anything.
Okay, Adam, let's just pause it there for 2 seconds. Everybody watching and listening, please leave a comment and tell us where you're watching or listening from, and tell us whose side you're on. Were you on the side of the billionaire hedge funds, or were you on the side of the Redditors and the Robinhoods? I guess I'll say it way that the customers of Robinhood, not Robinhood the company, because they should be indicted. And all the lawsuits are flying, by the way. Yeah. Go ahead, Adam. What?
Yeah. Comment if you own any GameStop. I'm curious, because there were some Redditors who flat out said, I'm buying at this price and I don't care if I lose money because I'm sticking it to Wall Street. Mm-hmm. And to those people, I tip my hat and say, hope you don't lose too much money. But, if they're doing it. And so there's some people who made a lot of money, and there's some people who just said, I don't care if I make money. This is my protest. So if you own GameStop, I'd be curious to see that in the comments and tell us your holding strategy.
All right, folks, come on, don't be shy. Make some comments here. We love hearing from you. And if you have any questions about, we're about real estate investing. So especially real estate investing questions, put them in the comments and we will get to them. Okay, Adam, let's keep going.
Yeah, so we've talked about this before, but remember, when the service is free, which Robinhood trading is, you are the product.
Good point.
And, Citadel, their customer is Citadel. Their customer is not you. They need you to trade so that they can sell it to Citadel, but you are not their prime. Whenever the clearinghouse comes knocking, they care more about, appeasing the clearinghouse than keeping you safe as an investor. Because all right.
They're in it for themselves, Adam. Where are all the clients' yachts?
Yeah. So commandment number 3, as Jason said, thou shalt maintain control. You decide as the owner of the property when to buy, when to sell, and what to target your rent for. You can't demand, and say, I'm going to rent this for $1,500, but you can start at that point and say, this is what I want. And nobody's going to come knock at your door and say, yeah, you can't rent this house at this price. That's, as long as you're offering it to everybody, then you can offer it for whatever price you want. So, you get out from under it. You don't have anybody coming up and knocking on your door and saying, you can't sell this house right now, so you get away from all of that that you're experiencing.
Now that's true, unless you are in the Socialist Republics of California or New York, because there they are definitely exerting, you have real political risk in those places. They are definitely exerting a lot more control over you. You can still sell your property, but if you have a tenant in it, you've got all sorts of problems, where they really complicate it.
But even then, the rules going in.
Right. Good point. Yes. The rules aren't made up. It's unconstitutional to make laws retroactively, right? And so that's basically what Robinhood did, because they're disgusting and shameful and pathetic. And, they decide they didn't notice, they didn't think this could happen. And then when it did, they got pressured by Citadel mainly. And they just changed the rules. There was no rule saying they could do this before. Now, I'm sure every Robinhood trader got an update to the terms of service policy after this, but yeah, it's incredible.
Yeah, before we go on, I want to take Ezra had a comment saying, I'm new in investing in stocks and so far I'm doing okay, but all this hedge fund stories are scaring me. Do I take it all out at this point?
Yeah.
Ezra, I can tell you from personal experience, my wife and I sold a good chunk of our stock portfolio to buy a property, and I have not regretted it. It's just, I really think based on everything you see in our society with the, kind of the small guy rising up, that this isn't the last time we're going to see a group of people, targeting stocks that a big hedge fund owns. And if you're investing in individual stocks, if you happen to be in one of those stocks whenever it happens, you could make a ton of money, and then the next day you could be wiped out. It's gambling in a lot of ways in this case, because you never know who they're going to target whenever they come for their next person.
Yeah, no question about it. And we know that now we all know that the gloves are off, and these big wigs and the big players will stop at nothing. They will censor. They deleted the subreddit thread for a time, and Reddit did put it back up to their credit. But it was deleted for a while, and people couldn't access it, so they couldn't talk amongst themselves and figure out things that they wanted to do. It's just a really scary scenario, folks.
Yeah, I find it interesting that in all of this, in the aftermath, the only discussion that has been happening among federal regulators has been, are we going to go after the individual investors who teamed up against the big,
unbelievable,
the big, happy, innocent hedge fund who was short this stock? I mean, if you take, and I commented this on the Book of Faces on Facebook, and I said it's incredible to me
I like that
if a company takes thousands of people's money, pulls it together, and invests it, perfectly fine. If thousands of people join together and decide to invest their money, that's collusion. That's illegal.
Right.
You're not going to allow it.
But big tech companies and other big companies can have all sorts of antitrust violations that go unnoticed.
Now, I agree that like the pump and dump stuff where you just promote fake information just to pump up the stock and then you sell it before it crashes, that you should look at from individuals and companies.
Yeah.
But if it's just a group of people saying, hey, I like GameStop, hey, I'll go in with you, it shouldn't be illegal. And if they're the ones, if you're going to get investigated for that, then all these people who are promoting, hey, give me your money so I can manage it and we can invest in as a large block, well, then that's clearly illegal.
Yeah.
If that's the case, they're just promoting illegal activity. So
let me share something, Adam. You probably saw this on my Facebook the other day, but it's about the Robinhood censorship component, and this is just oppressing investors. So, well, I'll just read it to you first, and this is from the Sovereign Man. Okay, Google deletes over 100,000 negative Robinhood reviews. Last week, we talked about how YouTube was deleting dislikes on White House videos because they were vastly outnumbered the likes. So I guess people don't like the newly installed administration as much as they apparently, I don't even want to say the V word, but they cast a ballot for. You have to talk in code now because hopefully the algorithm won't catch what I'm saying, right? But it's getting smarter all the time, sadly. So it's pretty scary. So they were deleting the dislikes because they wanted our president to look better than the public thought of him, right? So this week, Google was helping out Robinhood, the stock trading app caught up in the whole GameStop saga. Robinhood banned users from buying GameStop stock, and that was seen by many users as fixing the market in favor of the big hedge funds. As a result, an army of angry customers left negative reviews on the App Store. So Google has the Play Store if you have an Android phone, and it's a Google app, right? Bringing Robinhood's app rating down to 1 star. But then Google removed over 100,000 negative ratings, restoring the app's status back to 4 stars. And the excuse was the same as last week's pathetic reasoning to delete White House dislikes. Sometimes Google claims they delete ratings because that is how it determines they determine it to be spam or insincere. The fix is in from the stock market and the social media likes and everything in between. We all are told that we have to obey. And this is just absolutely pathetic. It is so scary. I'll actually put this piece in the comments so you can read it for yourself. And it's from Simon Black. Okay,
I can guarantee you all of those reviews were very sincere whenever they gave it.
I'm sure they were. Yeah. Yeah. Good stuff. Okay, Adam, what else do you have for us?
Yeah. So then I hear people saying, but housing could come crashing down because we have seen the run up. So if you're not going to invest in the stock market, where are you going to invest? Two weeks ago, we covered the compared to what. You can go back and watch that when we looked at returns. But potentially the housing market has seen a big run up. It could come crashing down if
I'm sorry, just let me interrupt you for a second. I just pasted that into the thread, in the comment thread, but it looks like it was too many words, so it split it up into multiple, I think 3 posts. So read it before it's deleted. Go for it, Adam.
All right. So for example, talking about the housing, this is from a Redfin report that was released about a week ago. It said nationwide, 27.8% of Redfin users look to move to another metro area in 2020. That's up from 25.5% in 2019, a 9% year-over-year increase. The increase is driven, shockingly, by people leaving expensive coastal areas for relatively affordable places. New York, LA, and the Bay Area are the only places where inventory rose year-over-year.
Well, these people are very smart. To leave those big cities.
So relatively affordable southern and southwestern metros gained the most residents in 2020, and they all experienced double-digit supply drops. Phoenix gained roughly 80,000 new residents in 2020, a bigger net inflow than any other metro area. Next came Dallas with 75,000, then Orlando with 60,000, followed by Tampa, Austin, Vegas, Atlanta, Greenville, South Carolina, Charlotte, and Knoxville. So these people are moving out of the expensive markets that are seeing declines, moving to these markets where we are in massive numbers. Atlanta and Charlotte, we either have properties or have recently and will soon again have properties, and that are cash flowing from day one. And so it's kind of, you look at the supply of housing, and is it going to crash right now? I don't see it. I mean, Jason and I were talking before we started of when do you see it coming down? And I do see it slowing down. I'm not somebody who thinks the national housing market is going to go up forever and ever. But as long as we have this supply crunch and we have the money coming in, the fiscal flows coming in from the government, it's very tricky to force something to go down. It's just hard.
Yeah.
I mean,
like what is the narrative for a housing crash in the next year or two? I just don't see it. I mean, listen, people have accused me of being a permabull, right? I'm not a permabull. I mean, I've been doing this a long time, and you can just go back and listen to my old podcast episodes when I'm rather pessimistic, when I'm talking about, all of the landmines in the marketplace. They're out there. But right now, with this massively cheap money and a structural housing shortage, especially in desirable suburban areas, and the cost of construction going through the roof, I just don't, post a comment and tell me, like, don't give some hit and run comment, okay? Give us a well thought out comment with proper shift key and capitalization and punctuation, please, so we know you're smart, and or at least not a millennial. Well, Adam, what is it about you millennials that are too lazy to push the shift key? I don't think you're that way, but some are.
in casual conversation, I am.
Yeah, it's just my generation. You always push the shift key. I'm talking like an old person now. Okay, whatever. But
I think
tell us the narrative for a housing crash, like in the next year or two. I don't know where's that narrative. Go ahead.
I think the big thing is just people say it's gone up too much. But I heard, I was listening to another podcast and they were talking about pricing, and this was a stock investing one, and they said something that really hit me and made me think that it was right. And they said, price is just a product of conditions. And we are in a condition right now where the price is right. I mean, the conditions are such that it's for a housing boom. And so prices are going to reflect that. Until conditions change, you can't expect the price to change. The conditions are just, the government right now is telling us, everything in society is telling us, we are going to see an increase in housing prices.
Yeah.
All signs point that way.
There just is not a narrative. I mean, I don't know, an entire economic collapse, a sudden, start of a war, who knows? I mean, that, things, there's always something, right? You can never say for sure, but it just, I mean, the overwhelming signs right now are that we've got a pretty clear road ahead of us for a while for housing prices to keep escalating in the right areas. Remember, 3 types of markets in the United States or the world: linear, cyclical, and hybrid markets. If you want to know more about that, listen to the Creating Wealth podcast and learn more about it. But yeah, things are looking pretty powerful right now.
Yeah, so I found this graph, and we've talked about the housing shortage before, and this is from the U.S. Census Bureau, and it was 1982 is the only year before 2006 that had fewer units built than 2017. The population of the U.S. now is somewhere around 330 million.
Yep.
Back in 1982, it was 231, I believe. So I mean, we have 100 million more people.
And we're going to add another 70 million people before anybody listening pays off a 30-year mortgage they take out this year. Another 70 million people in this country. Okay, that's the projection. So, I don't know. It's just looking pretty darn positive. So, don't wait to buy real estate. Buy real estate and wait. It's the most, income property is the most historically proven asset class in the entire world. It's the most tax favored asset class in America.
Yeah. So from 2017 to 2019, in 2017 to 2018, housing starts went up 46,900 roughly. And from 2018 to 2019, housing starts went up about 40,100. Then you compare it to the growth in population, we had a 2.1 million increase from 2017 to 2018, and a 1 million increase from 2018 to 2019. I mean, we just keep getting, if you compare that to number of starts to how many people would have to live in each household, it's just, I mean, we need to be building 2 million or more houses a year.
Yeah.
Realistically, to keep up with the demand that's happening. And
right.
We're nowhere near that. And the builders have pretty much come out and said, we're not going to be near that. They just can't do it. So it's all pushing forward, and it's not looking good. So right now, if people are concerned about a housing crash, if you are one of the people who say it's going to crash, and Patrick, I promise we'll get to your question in just a minute.
And Patrick supplied us. Thank you, Patrick, for doing the fact checking. Patrick is a legitimate fact checker.
I thought it was 231. I was worried it was 271, but I was pretty sure it was 231.
Yeah, there you go. And look at this one. He's a millennial who gives a shift. I love it. It's good.
Yeah. So right now, if you are concerned about a housing burst, I would highly suggest that you buy a property that's an option. And that would be with one of our builders in Florida, who has had such a high demand that and if you look at the bottom of this, estimated completion is end of the year to beginning of 2022. So if you
Adam, why the heck is your screen so blurry? This is
I had to take a screenshot and then blow it up. I don't know.
You know what it is that you're using a PC. On a Mac, those screenshots come out real clean, but Apple uses child labor and abuses children, and Tim Cook is a hypocrite. But go ahead.
Yeah. So this property is
so I don't want to promote Apple, you see.
So this property is roughly $250,000 right now, has an $1,800 rent that'll estimated $1,800 rent, and it estimates to make you about $321 a month. So, and this is, like I said, scheduled for completion at the end of the year or beginning of 2022. So if you think it's going to crash, you put in your binder to lock in the property, and it locks in your price. But maybe there's a huge crash between now and then. Well, Jason, what happens if there's a huge crash and you go to the bank and you ask for a $250,000 loan on a property that appraises for $200,000?
Well, they're going to give you that loan, no, they're not going to give you that loan. So that's not going to be available. Yeah,
they're going to laugh at your face and say, no chance we're going to give you $250 for that. It's only worth $199 now. So suddenly you go back to the provider and say, hey, I'm not buying this thing for $250 because I can't get a loan. You're not going to be able to sell this to anybody for $250. Let's renegotiate. And they're going to negotiate with you because they want to sell the property, and they know that there's been a crash. It's only appraising for, in this case, I just dropped it $50,000. So that'd be a 20% drop in the housing market. And this is in Florida, where numbers are not headed that way. So I dropped the asking price $50,000. I dropped the rent about 10 to 15%, since they lag a little bit behind. So I put it down $200. I dropped the property taxes to reflect roughly a $200,000 purchase price, and it still cash flows. It's not as great a deal, but it still cash flows positively. And it still works. Even with the interest rate, I bumped it up. Right now, you're getting 3% at 25% down. I bumped it up to 5%. I upped it 2%.
Yeah, that's incredible. And Adam, the thing that you also need to consider is that when the market softens and prices decline, that puts upward pressure on rents so long as the population is steady or increasing. Because renters want to move out of the rental pool and into the ownership pool. And when they can't do that because of low housing affordability or a high unemployment rate or, whatever the problems are in the economy, right? They're forced to stay in the renter pool, and that means more demand for limited supply. I teach this in depth in something I call the 3 dimensions of real estate. And of course, you can check that out on the Creating Wealth podcast. By the way, if you want to be able to find these things, all you need to do is go to jasonhartman.com. There's a search bar there. powered by the evil Google people. And we have a lot of wonderful clients that work for Google, but I'm just saying the whole enterprise, right? We have a lot of wonderful clients that work for government, but we're not going to say a lot of good stuff about that either. And you can search. So just type in 3 dimensions of real estate, 10 commandments of successful investing, double inflation arbitrage, all of these concepts that we talk about. But we didn't talk about that one today. So that last one.
And just remember, there are 23 Ten Commandments.
Yes, there are 23 of them now. We can't count very well. It's Adam. It's inflation. it's commandment inflation. We came up with 10 and we thought of 13 more. Yeah.
So that's what I've got for today. So let's go and take Patrick's question that he asked a little earlier.
Good stuff. Okay, let me get that on the board here. There you go.
So Jason, I have a weird question with regards to CapEx. Basically, I've seen 1% properties at approximately 70 to 80,000. Does it make sense to steer away from these since CapEx will be much bigger percent of overall cash flow?
Okay, so first, let's tell everybody, what does he mean when he says CapEx? So that's a capital expenditure, right? It's instead of doing a minor repair like, repairing the lock on the door, or, doing some small repair, replacing a garbage disposal, for example, or, fixing a toilet that's running, right? This is a larger expense. It's a capital improvement to the property. Something like a new roof, or redoing the landscaping, or something significant, redoing the flooring, right? This is an improvement that will last for many, many years. And so these improvements should be considered when looking at older properties. On new construction, it's going to be hopefully a long time before you have any CapEx consideration. But on an older property that isn't rehabbed, and when I say rehabbed or renovated, there's 50 shades of gray there, right? To use a well-worn cliche. So you need to understand what you're getting in terms of that renovated property, right? And of course, you're going to have a home inspection, and you're going to be a prudent buyer, and you're going to be aware of what you're going into in advance. And so for that, you do need to consider that you might have some CapEx depending on what that home inspection tells you and how old that roof is and all of those kinds of questions.
Yeah, and really that's why.
Sorry, Adam. One more thing before I forget. I hate to interrupt, but I forget. I'm old, so I'm gonna forget. Just understand that you're gonna buy that property hopefully for less money to be able to budget that CapEx. Go ahead.
Yeah, and you also need to keep in mind there that that's why those properties tend to give you a better return percentage-wise,
right?
And it will allow you to put money in the bank to keep up for that and make sure that it's, you have that maintenance fund in place that, Fannie and Freddie require. So usually, you'll see a $70,000 or $80,000 property that's getting the 1% rent to value. You'll probably be cash flowing, I would guess 9 to 10% return on that property. And that will allow you to, and this is why a lot of our people just gravitate towards new construction, is because by the time it's all said and done, there's potentially not a huge difference in returns between your new construction and your rehab, but the peace of mind of knowing that everything is brand new. It just passed the certificate of occupancy from the government. If anything goes wrong on the inspection, it's 100% guaranteed the builder knows that it's their fault. Everything
for a period of time, though, not forever.
Right, but I'm talking about on your initial, inspection report. You're going to say, "Hey, guess what? This wasn't. This shouldn't be there because it's brand new." So that's why people tend to gravitate more towards the new construction. But you just have to, if you're buying like a new construction at 6% versus a rehab at 6%, you want to be sure that everything in the rehab is brand new.
Right. So those renovated houses, Adams calls it rehabbed. I say renovated sometimes. And so, there are varying degrees of what they're doing. Some really just do great renovations and some don't. Some just put, as the old cliche says, lipstick on a pig. Okay. And they just do some basic stuff. So, again, just know what you're getting into and be a prudent buyer. And that's what we're here to help you with. I mean, we have clients that are buying properties nationwide in many different markets. They're almost always far from where they live. Most of the clients buy without seeing the properties. And so, that's what we're here to help you with. And that's what Adam and our other team members do all day long. Okay, here's another question from Patrick.
Oh, this was earlier when he was asking how we were talking about Robinhood.
Yeah.
He said, finance is a joke of I'll manage your money so you make a killing. Oh, wait, it's a slot machine, except I'll charge you a fee to put your money in.
Yeah. It's ridiculous. They win either way. Right?
Yeah. All right.
Yeah.
So
what else do we have here? Let's see.
Josh gave Pat an answer saying any real estate asset requires a detailed DD eval. Even new property should have
due diligence, I think is what that means. Yeah.
Even new property should have a thorough inspection, 100% guaranteed. So I want to talk a little bit about people have asked me over the months and years about, saying I've done deals with other real estate companies and gotten scammed or lost money on it. I want to tell you the biggest way you get scammed in real estate is when you pay all cash for a property you've never seen. And when I say you've never seen, I mean you haven't checked it out on Google Street View, you haven't sent an appraiser there, you haven't sent the home inspection. And I've told clients, if I ever just call you up and say, hey, you need to buy this cash today, hang up on me. I mean, honestly, these properties, if you look at some of the ones where people have gotten sued, I believe there was a big one recently. I don't really want to say the name, but they were sued because they were selling homes that had been like burned down.
Yeah.
And it was because they had convinced these people to trust them. And then they were having the people buy these properties sight unseen cash. And when you do that and the bank doesn't take a risk, you're not having those extra layers of due diligence go in and seeing what you're buying.
In other words, what Adam's saying is that the bank, since they are essentially your partner in the deal, they are wanting to protect their collateral. And so, use that to your advantage, right? I mean, some of our clients certainly buy with cash. Okay. There's nothing wrong with buying with cash. He's just saying that gives you it gives you like a second inspection. It's not a real inspection, but they have a motivation to protect their collateral, right?
Yeah, that's why I say, if I tell you to pay cash sight unseen, waiving everything else, just hang up on me.
And don't do a pressure deal. I think that's really the bottom line. Don't be pressured, right?
Yeah, I mean, the people who I've heard gotten scammed the most, just blindly trusted, bought sight unseen with no inspections or anything, and don't do that. With us or with anybody else, don't do that.
Yeah, don't do that. Be an aware, educated buyer. By the way, I just put in the comment thread another place where you can check out our more controversial videos that don't get taken down. So if you like to know the real truth instead of just the fake news, make sure you go there and subscribe as well.
You want to see all the videos of Jason trying to get kicked off the major platforms.
Yes, absolutely. And I think that should maybe be considered a badge of honor. I'm sort of joking when I say that, but yeah. Here's an interesting comment about debt being an asset. And that is absolutely true. Good long-term, artificially cheap, which is what we have, fixed rate debt that's 3 decades long, 30 years long, attached to an asset like a property that's indexed to inflation is phenomenal. Go to jasonhartman.com, type inflation-induced debt destruction, and listen to my podcasts on that. It will blow your mind. This is a term that I trademarked many years ago because it's a unique idea. It's the hidden wealth creator for real estate investors, inflation-induced debt destruction. And it really shows you how that debt is a big part of the income property asset.
Yeah. And Michael threw up, I can vouch for Jason and Adam, easiest real estate transaction I've ever had.
Hey, thank you, Michael. Yeah,
Yeah,
and I remember I met Michael years ago. I mean, online, met on Facebook, and I was actually on his podcast years ago. So that's awesome. Thanks, Michael. Appreciate the testimonial there.
Yeah. So that's all I had for today.
All right. Well, folks, let's wrap it up. Thank you so much for joining us. On the bottom, we have our free mini book offer at pandemicinvesting.com, which basically gives you some really good insights into how to invest during a pandemic. A lot of things are changing. A lot of balls are up in the air. Wealth is being moved around. There's a big wealth transfer. So go get your free mini book at pandemicinvesting.com. Feel free to check out some of the other resources that are in the show notes here or in the comment thread. I've dropped them in there throughout our presentation today. And Adam, thanks so much for joining us. And we've got another podcast coming out today. We're 3 days a week on the Creating Wealth Show, every Monday, Wednesday, and Friday. So those podcasts are available wherever you get your podcast on any platform. And we will look forward to seeing you next time. Thanks again. Thanks, Adam. Bye-bye.
All right.